Everyone thought San Francisco's housing market was bulletproof, but 2025 just threw us a curveball. Prices are shifting, homes are sitting longer, and the rules of the game have changed. It's not a crash, it's not a boom, it's something way more interesting. And if you're buying or selling here, you need to understand why this reset could be your biggest opportunity yet. Before we take a closer look, let me introduce myself. I'm Erik, former tech exec turned realtor. I help a lot of folks buy and sell their homes in San Francisco that I've met right here on YouTube. I'm only a text away if you'd like to get the process started as well. Okay, let's jump back in. Let's talk about where the San Francisco market really stands now in 2025, because this is where the shift becomes crystal clear. A couple of years ago, you were house hunting in the city. It almost felt like you were in a race you couldn't win. Homes were going pending in 3 or 4 days, sometimes even before the first open house weekend wrapped up. Multiple offers, crazy overbids, buyers writing love letters. I remember open houses in Noe Valley and Bernal Heights where 20 or 30 groups were walking through the door just in the first hour. It had the energy of a street fair, except everybody was trying to outbid each other. Okay, let's fast forward to today. That atmosphere is almost completely gone. Now, San Francisco is still expensive. Single-family homes are still at 1.7 million median, 2-bed condos about 1.25 million, but the pace, the psychology, the day-to-day rhythm of the market feels completely different. One of the biggest shifts is inventory. Years ago, you'd be lucky if 1 or 2 homes came up in a neighborhood at the same time. Now buyers are looking at 5, 6, sometimes 7 or 8 neighborhoods all within the same month in the same neighborhood. That's not a flood, but for San Francisco, where supply is usually tight, the change is noticeable. And that extra choice is changing everything. Buyers no longer feel like they're competing to get on the last helicopter out of town. They feel like they can shop, compare, take a breath before making a decision. And you can see it in the days on market data. Single family homes now take an average of 13 days to find the right buyer. Condos, the number's at 28. That extra time matters. It creates leverage. If you have a home that's been sitting on the market for 25 days, buyers walk in thinking, well, maybe the seller's ready to negotiate. And that thought never crossed the mind of people who were buying 3 years ago, because homes were gone before you could even blink. Remember that, because when we get to the opportunities and risks later on, leverage is going to be the key theme for buyers. Quick pause before we keep going. If you find this information helpful and you want a local's take on the San Francisco housing market, go ahead and subscribe. Every video I make is designed to give you the clarity that you need to handle one of the toughest real estate markets in the country. Now let's talk about the psychology at an open house, because that has shifted too. Instead of feeling like a feeding frenzy, buyers strolling through, asking questions, checking their phones, pulling up comps on the spot, things feel more in control. Sellers, on the flip side, are realizing that strategy matters once again. Pricing high and waiting is no longer the winning strategy. If you overshoot the price on your home, the list price, your home sits, and once it sits, the market punishes you. Buyers assume there must be something wrong with the listing. Listings that win today are the ones that are priced in line with reality. It is also important to stage them properly and market with intention. Now, this reset has not hit all neighborhoods in the same way. Single-family homes in Pacific Heights, Presidio Heights, or Noe Valley still attract strong attention if they are positioned right. Buyers there value lifestyle and location so much that they will act quickly if the price is right. But condos, for example, in Soma or Mission Bay or the financial district, they move a lot slower. HOA dues will look a lot heavier. And with remote work reshaping priorities, fewer people want to pay a premium to live near an office tower where they're only visiting once a week, 3-4 times a month. And we'll dive much deeper into how those exact neighborhoods are performing in just a bit. So let's pull this up together. What we're seeing isn't a collapse. It's not a free fall. What we're seeing is a market that's becoming more balanced and more realistic. Prices have corrected from the peak. Inventory is higher. The homes are taking longer to sell. Buyers finally have the time and choices. And sellers have to be more strategic again. In plain terms, the San Francisco housing market has entered a new phase. It's not the panic buying of 2021. It's not the fire sale of 2023 either. It's a reset, a correction. And before we get into which neighborhoods are winning and which ones are losing, we need to understand why this shift happened in the first place. But now that we've laid out what the San Francisco housing market looks like in 2025, the bigger question is why? What's behind the shift? Because markets don't change in a vacuum. There's always forces pushing and pulling. And right now, there are 4 things that are shaping the San Francisco market: mortgage rates, the tech job market, remote work, and affordability. Let's start with mortgage rates, because this one hits everyone immediately. You know, back in 2020, 2021, you could just hop online, apply for a mortgage, and boom, you'd have a 2.5% 30-year fix just like that. And no matter how much higher offers were compared to the recent sales data, the banks were appraising everything just fine because the market was going way up. So if you bought a house here and you were looking at sales data that was from 30 days ago, well, that offer was actually written 60 days ago. So if the data says the home's worth $2 million, but you're putting an offer in at 2.3, 2.4 million, bank appraisals, almost all of them were fine. That's unheard of in modern housing history, and that's what fueled the bidding wars. At those rates, a $2 million house, which sounds insane on paper, penciled out to be more for families than what you'd think. Here's what I mean. At 3%, a loan for $2 million would cost you about $8,400 a month, principal and interest. Now that's still a big payment, but for dual income tech households that are combining for a $500, $600, $700K a year, it felt doable. And with everybody competing in this environment, buyers stretched to win. Now fast forward to today, mortgage rates are still around 6%. So let's look at that exact same $2 million loan. Now it's closer to $13,000 a month. Nothing about the neighborhood has changed. Square footage is all the same, but the monthly bill is $5,000 higher. And for a lot of buyers, that extra cost is a line that they cannot cross. So what happens? Some buyers drop out entirely, some reset their budget. The buyer pool shrinks, especially at higher price points, and that pressure trickles through the entire market. We'll see exactly how that shows up in mid-tier neighborhoods when we get there. But it's not only interest rates. The tech job market has also been a game changer. San Francisco is tied to tech more than any other city. So when the tech is booming, so is San Francisco housing. When tech is shaky, housing feels it immediately. And over the past few years, we have seen some waves of layoffs. But here's the thing, most of the buyers in San Francisco, they still have their jobs, they still have stock, they still have RSUs and other investments, they still have strong incomes, but the psychology has changed. I've had buyers flat out tell me, my role is safe today, but I'm just not sure if I want to handle a $10,000 a month mortgage payment right now. And that hesitation matters. Even financially secure buyers are slow to pull the trigger, and that has slowed the entire market. Now layer that on top of the remote work revolution. At first, people thought remote work would empty out San Francisco, and that just did not happen. Now there was an exodus, there was a mini evacuation from downtown, from Soma, and it did move the needle, but nothing nearly as bad as what the San Francisco haters were saying. The city still has energy, there's still demand, people still want to be here, but remote work has definitely reshaped buying patterns. Fully remote workers realize they don't have to be in the city and pay premiums if they don't want to. They can move to Oakland, Walnut Creek, or even further out in Sacramento or Santa Rosa. They could get a bigger house with a yard, and they could still keep their Bay Area salaries. Meanwhile, hybrid workers, the ones who only have to be in the office 1-2 days a week, 3-4 days a month, they still need access, and that's why the neighborhoods with shuttle stops, with BART access, quick routes to downtown became more desirable. Noe Valley and Glen Park with its tech shuttle routes, Inner Sunset with its easy access to Golden Gate Park and Muni, Potrero Hill with its walkability and multiple freeway access. Those areas still make sense to people splitting time between the home and office. So instead of demand just disappearing, it's been redistributed. The buyers who were all in Soma and South Beach competing for those condos are now spread throughout Oakland, the Peninsula, Marin, and other San Francisco neighborhoods with farther commutes. And you'll see how that redistribution is hitting condos hardest when we zoom into specific neighborhoods. And then we come to affordability. Even with prices down from its peak, San Francisco is still one of the least affordable housing markets in the country. That hasn't changed. When families sit down and run the numbers for the mortgage, the property taxes, the HOA dues if it's a condo, they realize that their monthly cost here in San Francisco could buy them a lot more somewhere else. Now, San Mateo County and Santa Clara County have leapfrogged San Francisco in median home sale price for single-family homes. San Francisco's at $1.7 million, but San Mateo and Santa Clara County are both just over $2 million. Marin County is tied with San Francisco around 1.7, but both Contra Costa and Sonoma County are under 900,000, under $1 million. So every time that a buyer makes this calculation and decides to buy outside of San Francisco, the city loses a little bit from the demand pool. And the tricky part is those decisions are not simply about money, they're about lifestyle. If you're a family, you may ask yourself, do I want a small backyard in the Sunset or do I want a bigger one in Marin for the same payment? Not to mention the seasonal migration that we see from San Francisco to Marin County during school season when families are applying for private schools in San Francisco, and if they don't get their top picks or they don't get in at all, we see a lot of those families move north to Marin and just put their kids in public schools. And if you're single and you only have to be in the office a handful of days a month, you might wonder, do I want to pay $800, $1,000 a month for a one-bedroom condo in Soma? Or should I just go buy a single-family home in North Oakland, Berkeley, Emeryville? I can get a 3-bedroom, I got a guest room, I've got an office, I've got a backyard. So those are the real trade-offs that buyers are wrestling with every day. Now here's the key point. It's not only the math, it's the psychology that comes with all this. Higher rates have changed what buyers feel comfortable with. Waves of layoffs make even secure workers think twice. Remote work reshuffled priorities, and affordability pressures remind people that they have options outside of San Francisco. And when buyers hesitate, sellers feel that pressure. That's why this market feels so different. It's not a single factor like rates or jobs, it's the combination of all of them at once. And together, they've turned a hyper-competitive, frenzied market into one that feels a lot slower, more fragmented, more cautious. This leads us straight into the neighborhood story because the effects of these forces don't play out evenly across the city. One thing that makes San Francisco so unique and also so tricky as a market is that it's not one big housing market, it's a collection of micro markets. Because every neighborhood has its own personality, its own demand drivers, and its own way of reacting when things shift. That's why in 2025, you're not seeing the same old story play out everywhere. Some neighborhoods feel steady, some feel soft, and some are right in the middle, caught between a strong lifestyle appeal and affordability limits. Let's start with the luxury neighborhoods like Pacific Heights, Presidio Heights, Nob Hill. These are some of the crown jewels of San Francisco real estate. Pacific Heights has those postcard views of the Golden Gate Bridge, huge mansions with stories behind them, and a level of prestige that is almost impossible to match anywhere else in the city, let alone the state. Presidio Heights offers leafy streets, access to Presidio Park, a quieter, more tucked away vibe while still being central. And Nob Hill has that old world elegance through historic buildings, iconic hotels, and sweeping downtown views. Now, what's happening to these markets in 2025? They are holding steady, not because they're immune to the broader shift, but because the buyers here play a different game. Many of them are using all cash or they're putting down huge down payments, so they are less sensitive to the mortgage rates, and they know a deal when they see it. They know as time goes on, and especially as the rates go down, prices are going to slingshot, and we're not going to be talking about how the peak of the market is behind us. We're going to be talking about how it's ahead of us. Plus, they're buying for the long term, the investment, the prestige, the legacy, the lifestyle. They're not buying because they're stretching to qualify or they're trying to get out of a rental situation. That said, even in these neighborhoods, overpriced homes will still sit. I've seen Pacific Heights listings sit for months because the seller was anchored at a 2021 number. But when a home is priced correctly in these areas, it is marketed and staged well, it will move. It will get multiple offers and it will sell after 2 weekends. The scarcity factor is huge. There's only so many homes with Golden Gate views and walkability to the Presidio. That scarcity does project value, and buyers know these luxury neighborhoods recover a lot faster. They're usually the first ones to recover when the markets shift. Keep this in mind because it ties directly into San Francisco's bigger housing market cycle. More on that later. Now let's move into the mid-range neighborhoods. Glen Park, Bernal Heights, the Sunset and Richmond neighborhoods. This is where the shift is more visible. Sunset is another interesting case. For years, it was considered one of the more affordable parts of the city, but affordability in San Francisco is relative. Even in the outer Sunset, median sale price for single-family homes is $1.5 million. What draws buyers is the space, the backyards, a quiet neighborhood feel. Plus, you're right by Ocean Beach and Golden Gate Park. So for families who want more house for their money while still staying in the city, the Sunset delivers. But some buyers pause when they realize that same $1.5 million could get them a newer home that's got twice the square footage in a Daly City or South San Francisco. So the question becomes, do we really want to be in San Francisco? Do you care more about what's inside the four walls, or do you care more about what's outside the four walls? The Richmond tells a similar story, especially the outer Richmond. Lifestyles here are incredible. You're within walking distance to the ocean. Golden Gate Park is at your doorstep. Clement Street gives you endless dining opportunities. But pricing pressure is real. Buyers are negotiating harder. Instead of waving through whatever price the seller wants, they're pointing to the comparable sales and say, this one sat for 30 days. It took a price cut. Why should I pay a premium for this house? Now, homes still sell in the Richmond, but they are taking a little bit longer, and buyers feel like they have a little bit of room to finally push back. Now let's talk condos. We're going to talk Soma, Mission Bay, South Beach, those areas. This is the softest segment of the market right now. For years, condos in Soma were hot. Buyers wanted to be close to their office. They wanted to be able to walk to nightlife, live in sleek, modern buildings and lofts. Fast forward to today, where the priorities have shifted. Remote work means that being next to your office tower is not as valuable. At the same time, HOA dues in these buildings are steep, $800, $1,000, sometimes even $1,500 a month. When you add that to your mortgage and taxes, the affordability affordability math gets rough. Mission Bay is faring better than Soma because the buildings are newer, the layouts are more family friendly, you've got a lot more parks, you've got the waterfront. Median sale prices for a 1-bedroom condo in Mission Bay right now, 1.05 million. 2 bedrooms, 1.5 million. So when you zoom out, you see a very different story. Luxury neighborhoods are steady, supported by wealth and scarcity. Mid-range family neighborhoods are slower but still grounded in lifestyle demand. Condo-heavy neighborhoods are struggling the most, facing both softer demand and tougher competition. And this is where strategy matters. For buyers, fragmentation means opportunity. If you're willing to be flexible, you can find deals in certain pockets, condos especially, or time your move in family neighborhoods while competition is lower. Now for sellers, the lesson is that you can't rely on citywide averages. You need to know what's happening, not just in your neighborhood, but on your block. Because in San Francisco, market performance is hyper-local, and that's what drives outcomes. And this tees us up perfectly for the next topic, because understanding where the risks and opportunities lie is what separates the winners from the ones left waiting. Whenever a housing market shifts, people tend to default to extremes. Some think it's a disaster, others think it's the golden age. The truth is always more balanced. These shifts simply change where the opportunities and risks are. And for San Francisco in 2025, if you understand these market dynamics, you can position yourself to come out ahead. For buyers, this is the first time in years they've had genuine leverage. Let me paint the picture. Back in 2021, 2022, leverage did not exist. You were against 10 or 20 other offers. Now condos are the clearest opportunity. Take Soma, Mission Bay, or South Beach. A 1-bedroom that could have sold for 1.1 million in 2021 might now sell for 950K. And that's not pocket change, that's a 6-figure swing. And on top of that, buyers can now ask for things that were off the table a few years ago, like helping buy down points or putting down credits for future HOA dues, or just flat out making an offer well below what the current market value is on the place. Just because you cannot do that in the inner Richmond doesn't mean it's impossible citywide. Now, family neighborhoods are another place where you can find opportunity. The Sunset and the Richmond neighborhoods, for example, they're not cheap by any means, but they have softened. A family that buys here today may feel like they're stepping into a dip, locking in some long-term value in a neighborhood that always bounces back because it is fundamentally strong. And here's the underrated opportunity: time. In 2021, if you liked a house, you had to make a decision immediately. Today, you can tour it once, go tour it again, come back the next week, bring your family around, get all your documents in order for an offer. That breathing room is worth a lot because it reduces any kind of risks that you may make, any kind of emotional decisions you may make under pressure. Later on, we'll get to what that means for you. I'll show you exactly how to use that extra time to your advantage. But let's flip the coin. Just because you have more leverage doesn't mean it's risk-free. The first big risk is overplaying your hand. Like I mentioned, I've seen buyers get cocky, toss out random lowball offers because they've heard the market is down. Now, sellers are flexible, but they're not desperate. If you write an offer way under comps, you just will not win. The smart buyers are the ones who negotiate firmly but fairly, backing up their offers with data. Another risk is with condos. Yes, they are cheaper today, but not all discounts are created equal. In Soma, condos 20% below the market peak might sound great, but if the HOA dues are $1,200 a month and you believe downtown recovery is another 5 or 10 years away, you might find that the appreciation lag behind other parts of the city. Now, that doesn't mean avoid condos altogether or avoid Soma altogether. It means that you got to be picky. You got to look for good, strong buildings, locations that will hold long-term appeal, and dues that you are comfortable with. If you don't want valet parking and you're never going to use that rooftop pool or the gym, then you probably shouldn't be going after that condo with $1,600 a month HOAs. Now stick with me, because in a moment we're going to dive into which condo-heavy areas are seeing the biggest price drops. And then there's the timing risk. Everybody wants to buy at the bottom, but here's the thing: the bottom is only obvious in hindsight. If you wait too long hoping for prices to fall even further, you're risking missing the home that really fits you and your lifestyle. I've had clients hold off for months waiting for a better deal only to regret missing the place that checked every box earlier on. More times than not, waiting it out means that you've overpriced yourself out of the market. Now let's talk sellers. At first glance, you might think that this is a big, tough market for you. And yes, it's not as easy as it was in 2021, back when things sold no matter what. But there are still clear opportunities if you approach it the right way. The biggest one is differentiation. In 2021, you did not need to stand out. Today, you absolutely do. The homes that are selling well, that are selling quick in 2025 are the ones that are priced correctly and marketed properly. Now let's talk about luxury sellers because they are in a strong position. Pacific Heights, Presidio Heights, Nob Hill, they're still attracting buyers because those markets are driven by wealth and scarcity. And if you position your property correctly, you can still get excellent results. I've seen well-maintained luxury homes in 2025 get multiple offers because buyers know opportunity in these neighborhoods don't come around too often. Now, flexibility is another opportunity. Sellers who are willing to meet buyers halfway in negotiations when a home's been on the market for a few weeks, those folks are getting deals done faster and at stronger numbers than sellers who refuse to budge. Now, sellers face their own set of risks. The biggest risk, and there is not even a closer number two, is overpricing. Rule number one in San Francisco real estate is you can never underprice your home. You see single family homes listed for $1 million and they can still sell for $1.5 million, even $2 million. Now that's not too common, but it is real evidence to show you that you literally cannot underprice your house. But if you overprice it, it's going to cost you weeks and tens of thousands, if not hundreds of thousands of dollars. If you list your home like it's 2021, it's going to sit. And the longer it sits, the more the buyers assume that something is wrong with it. In this market, the first 2 weeks are critical. If you nail the price, you create urgency. And if you miss it, you end up chasing buyers with price cuts. And that almost always nets you a lot less than if you priced it right in the first place. Keep watching because we'll get into which strategies work best for home sellers later. Another risk is if you're selling a condo. With so much competition and softer demand, you may have to do more than sweeten the deal. That might mean offering credits, helping cover HOA dues for a year, or contributing to buying down points for the buyer's mortgage. For sellers that got used to automatic bidding wars, this can feel like a shock, but in 2025, it's a reality. And then there's the timing gamble. Some sellers think, I'll wait until the market bounces back. The problem is no one knows how long that will take. It could be months, it could be years. Meanwhile, you're paying the mortgage, the taxes, the maintenance, the HOA. For many sellers, waiting ends up being more expensive than adapting to today's market conditions. One last piece of the puzzle, recovery. When San Francisco hits a soft patch, not all neighborhoods rebound at the same pace. Luxury neighborhoods almost always bounce back first. The scarcity and prestige that drive these markets put them first on the road to recovery. There's also so many homes with Golden Gate views, Presidio adjacency. Family neighborhoods like Noe Valley and the Inner Sunset are usually next. Even when buyers hesitate, the fundamentals, the walkability, the strong community pull people back in. Families always need space, and these neighborhoods always deliver. Condo-heavy neighborhoods take the longest to recover. We've talked about Soma, Mission Bay, South Beach. These markets will likely lag until remote work stabilizes and downtown regains a little bit more of its energy. But here is the unique upside. Buyers who step into these markets now, while prices are soft, often reap the biggest rewards when confidence returns. So here's the bottom line. Buyers finally have leverage, sellers need strategy, and neighborhoods with strong fundamentals, whether it's the prestige, schools, or lifestyle, will come out ahead. This isn't a crash, it's a reshuffling of power. And if you play it right, there are opportunities on both sides of the table. That brings us naturally to the last big question. How do you apply all of this to your own situation? Let's get into what this shift really means to you. I have gone through the numbers, the drivers behind the shift, and how different neighborhoods are reacting. But what's most important on all this, what does this all mean for you? Because at the end of the day, whether you're buying, selling, watching the market from the sidelines, you need to know how to navigate the San Francisco market in 2025, not to the market from 3-4 years ago, not to the market you wish you had, but the one that's right in front of you. For buyers, the theme of 2025 is breathing room. This is the first time in years that you're not walking into a bidding war every single time. You could shop, think, negotiate. You still need a plan. There is still likely going to be multiple offers on premium neighborhoods, but it is nowhere near as chaotic as it was years ago. Step 1, get your financing in order. Rates are higher than they were, which means the monthly payment math is harder. And don't simply look at what banks can give you. Focus on what you're comfortable paying. I have buyers that are approved for $2.5 million, but they end up deciding to shop under $2 million because that's just what their budget fits, and that's just where they're most comfortable with. And that kind of clarity matters because it keeps you grounded when you fall in love with a house. Step 2, know your priorities. If your goal is long-term stability and appreciation, you'll want to focus on single-family homes in established neighborhoods. The Noe Valleys, Inner Sunsets, Pacific Heights. These places draw demand even when the market softens. They are the blue chip properties of San Francisco real estate. If your priority is simply to get into the city, stop paying rent, stop paying off all of your landlord's bills and mortgage. Condos in Soma, Mission Bay, South Beach are realistic entry points today. You're buying at softer prices, you're finally able to negotiate, but you still have to go in with eyes open because you have to factor in those monthly HOA dues and all the benefits they bring, and make sure that you're not buying too much. You're not getting too much where you're not going to be able to take advantage of those things, but you still end up having to pay for it. It's very rare for a renter to say, well, I'm just going to hang out and keep renting and I'm going to save up another $250,000. So in 5 or 7 years time, I can buy exactly what I want. Well, if you're looking at market predictions, in that time, you may end up playing yourself and burning all that time because housing prices could very likely go up that same amount. So the smart buyers take it step by step. They first get out of paying rent. They first get out of all that so you can take advantage of all the homeowner benefits yourself. That way, in 3 to 5 years, you'll have a lot of extra appreciation, principal pay down. You'll have all that equity. So when you can sell, take all that profit, almost always tax-free if you're only living there for 5 years, and use that to help you afford your dream home or that next step towards it. Step 3, embrace negotiation. If a home's been on the market for more than a few weeks, then go ahead and submit an offer at lower than what the seller had initially expected. But back up this offer with data, let the seller know there are other homes on the market that you're interested in, and also show them the data that shows exactly how much their home is worth. Like I always say, no matter what a seller may tell you verbally, you never know what they're going to do when you actually put an offer right in front of them. If they say, hey, my bottom number is 1.5, I'm not taking a dollar below that, write that offer for 1.45. You never know what they're going to do. Step 4, resist the urge to overtime the market. Everyone dreams of buying at the exact bottom, but here's the truth. The bottom is only obvious after it has passed. If you find a home that fits your budget, your lifestyle, your needs, your long-term goals, then that's the right time. One thing I always tell my first-time home buyers who ask me when the best time to buy is, the best time to buy was yesterday because you're renting. You're at a 100% interest rate. You get nothing back. You get no equity. As the market goes up and up and up, your landlord takes all those advantages. You get no tax breaks. Today's market is far better than the situation that you're in right now, and you just need to get in the game. For sellers, 2025 is not a market where you can just throw a sign in your yard and wait for 20 offers. However, it is a market where you can succeed if you adapt. Step 1 is pricing. This is the hill that most sellers die on. This is literally the number one reason why the vast majority of the homeowners that I meet with end up not doing business with me, because the market is not paying 2021 numbers right now. And if you are going to price your home like 2021, you need to understand that this is going to take many, many weeks, if not months, many price reductions, and we're going to end up getting a number that is far less than it would have been if we properly priced it to begin with. Step 2, presentation. In a slower market, you cannot afford to look average. Buyers scroll through Redfin and Zillow before they even set foot in your home. Performing the proper renovations will not only net you a 2 to 4x return on every dollar you spend, it'll get your home off the market faster, likely with multiple offers. And like I said before, you don't even need the budget to do this. That is what I specialize in. Step 3, know your audience. A Pacific Heights luxury buyer is not the same as a Soma condo buyer. One is looking for prestige and views. The other is looking for affordability and an entry point. Your pricing, your marketing, your staging all needs to reflect who you're selling to, because cookie cutter strategies in any way do not work in San Francisco. You need to be hyper local and hyper targeted. And step 4, be realistic about timing. Some sellers think, I'm just going to wait until the market bounces back, but waiting has a cost. You're paying a mortgage, property taxes, HOAs, upkeep. If you've got a window of opportunity where the tenant has left before you bring in another tenant, you don't know how many years it's going to be before that next tenant leaves. And if you own San Francisco real estate, if you own investment properties in San Francisco, you know how much cheaper properties sell when there's a tenant inside. And if you're considering the timing on selling your home, but it's not an investment property, you live in it, the number one consideration is what are you going to do afterwards? Because if you are going to buy something after you sell, there's no market where you can win as the buyer and win as the seller. So if we're 20% off market highs right now, you think you're going to lose 20% on the sell? Well, after you sell, you're going to be a buyer and you're going to be taking advantage of that gap. You're going to be buying 20% below. But if you wait 5 or 10 years until the market is peaked and now we're 30% higher than we were when you first considered selling, after you sell, you're going to turn into a buyer and you're going to be looking at a 30% premium on properties versus when you would have bought years ago. And here's the thing, the history is on San Francisco's side. During During the dot-com bust, San Francisco housing rebounded faster than anyone else in the Bay Area. After the 2008 financial crisis, the exact same thing happened. San Francisco's recovery outpaced everybody else. After 2019, when everyone predicted the death of San Francisco, prices skyrocketed in 2 years. The city has proven time and time again that when confidence returns, it comes roaring back. So if you're investing for the next 10 years, odds are you'll be glad you did it. If you're timing a flip or a short-term play, you probably need to be a little more cautious. But for long-term holds, San Francisco fundamentals have not gone anywhere. And remember those luxury neighborhoods we talked about earlier? They're your best indicator for long-term resilience. And history shows they're usually the first to prove the cycle is not broken. So what does this all mean in plain terms? For buyers, it's the best window you've had in years. You finally have time, leverage, and choices. For sellers, success is possible, but only if you adapt, price correctly, present properly, and be flexible. For first-timers, the fundamentals remain intact. San Francisco is still San Francisco. The city may feel slow right now, but history shows the city always bounces back. The market has shifted, but shifts always create opportunity. The key is knowing how to play it. So here's the bottom line. The San Francisco housing market prices have corrected from the peak. Inventory is higher. Homes are taking longer to sell. Both buyers and sellers have changed psychologically, but this is not a crash. It's a reset, a correction. And if you're thinking about buying or selling here in San Francisco and don't want to guess your way through the market, call, text, or email me for more information. I work with clients every single day navigating these exact shifts, and I'd love to help you build the right strategy for your goals. And if you found this breakdown helpful, make sure you subscribe and don't miss anything. In the meantime, check out this next video where I dive into the neighborhoods that are actually booming right now in 2025. And trust me, you'll want to see which areas are defying the odds and why they're the ones to watch this year. Thanks for watching, and I'll see you in the next one.